Oil prices have jumped sharply in the past few days, and that's been bad news for some emerging market economies. Whilst our longer-term view is that the pressures from both the supply side and from demand side will turn to the downside next year. So in Q1 next year, we're expecting the US economy to slow, which will weigh on demand. And probably from mid-year, we'll start to see supply pick up from US shale oil production. But these are medium-term factors. And in the short term, the surge upward is really starting to gather momentum, and some analysts are calling or forecasting a further maybe $10 to $20 on the oil price. So higher oil prices are bad news for emerging markets, and they will hit inflation and current accounts. But first, step back and look at the bigger picture of emerging markets that are already under pressure. So this year, we've seen tighter liquidity conditions as a result of higher interest rates in the US. We've seen risk aversion as a result of the trade war between the US and China that has strengthened the dollar. We've also seen crises in several emerging markets which have added to investors' fears. So as a result of all of this, emerging market currencies are weaker versus the dollar. Inflation expectations have risen sharply, and there will likely be an inflation shock still to come as a result of the pass-through of exchange rate depreciations that have already taken place, and as these pass through to prices. And if we look at the scale of those depreciations, we find that the likes of Turkey, South Africa, India, among others, are likely to face a significant inflation shock purely as a result of currency depreciation that we've seen to date. To this picture of rising inflation, we now add oil prices. Now, oil producers such as Russia and also Brazil and Mexico will benefit from higher prices, and some of those as well are making efforts to reduce the impact of those higher prices on consumers. Elsewhere in emerging markets, we find that oil prices historically have been a significant driver of inflation. And if we look across the emerging market landscape, then we find that the likes of India, Indonesia, and others, perhaps in Southeast Asia, are amongst the most vulnerable. So governments in some of these countries have been working to offset the impact of high oil prices by cutting taxes and increasing welfare payments. It's not only inflation, however. For energy importers and with current account deficits, then higher oil prices are going to cause a deterioration in their current account balances. And we do find, if we look historically, that higher oil prices have put considerable pressure on some of these more vulnerable emerging market economies. And as things stand at the moment, we find that South Africa, Turkey, India, and to a lesser extent Indonesia are likely to be the most vulnerable in terms of further deterioration of their current accounts. In South Africa, the hands-off approach of the Reserve Bank there will likely mean that the adjustment takes place via a weaker currency. In Turkey, there is already a considerable economic challenge facing the government there, and high oil prices are likely to exacerbate that problem. In India and Indonesia, we've seen governments really trying to supplement the monetary policy measures that have been implemented. So governments have been trying to subsidize the impact of oil prices and also to reduce imports in order to limit the impact on the current account balance. If, however, oil prices do continue to rise, which is clearly a risk given the momentum that they've gained, then investors are increasingly going to focus on who are the winners and who are the losers amongst emerging market economies. And those economies that are most vulnerable, we've identified, will have to take stronger measures to combat the higher oil prices.